What do you think about, first of all, this idea that we've hit a peak, or we're entering a peak decade? If you look at the 20s as starting this year, are we going to start to see a decline in things like globalization?
Well, obviously, after a decade of basically an environment that remains relatively difficult, where growth has been challenged, it's pretty normal to expect at some point some kind of rupture. I would be actually in the other camp, thinking that what has been our investment constraint for the past 10 years, i.e. slow growth and low rates, is going to be among us for much longer than what has been anticipated so far.
What kind of rates changes do you expect in 2020?
Well, very little change. Again, economic activity might start to bottom this year, and we do see in the data that things might improve somewhat. But very clearly, it's not going to be a flamboyant recovery. We're in this for something that seems very laborious in the gradual improving of the data. So that basically leaves us in an environment where growth is going to remain challenged and around the numbers that we've seen in the past decade. So let's say around 2% in the US, maybe 1% in Europe, and maybe closer to zero in Japan, which would obviously leave central banks in the accommodative seat. So we know that whether it is the ECB or the Fed, they don't want to change their stance right now, and they would like to prolong this kind of slow rate environment. So very clearly, not a lot of change. If we get a bit of market volatility, maybe some of the big central banks will react, but clearly we're going to remain in this again slow growth, slow rate environment probably throughout the 2020 year.
I have to ask, since you're sitting there in Switzerland, how difficult has it been to invest with the moves in the Swiss franc, and do you expect 2020 to look anything like last year?
Well, clearly it's difficult. It's much easier to manage US dollar portfolios where you have a little bit more yield, or even euro portfolios for that matter. But again, it's been, we've been in this negative interest rate environment for 5 years now. The Swiss National Bank first engineered the negative interest rates in 2015. So we've, come across these things, and we know how to manage our clients' life saving in a context of, again, very slow growth and even negative rates. There are solutions to that, whether in carry strategies, trying to go for international credit. Obviously, and we do see that very strongly in Switzerland, real estate, and I'm not thinking about listed real estate, but rental real estate, the real asset is also, part of a strategy when rates are so low. So we do find alternative carry strategies, and again, equities with dividends, earnings growth visibilities are also part of a portfolio in the context of rates that remain at very low levels.